Well, it reflects certainly the fact that growth was already expected to weaken. Global growth was already expected to weaken at the time at which we finalized our assumptions for this round of projections. And yes, we've seen the oil price declining and pretty much reflecting and bouncing back and up depending on the views about the state of the global economy. We've seen oil prices in the last few weeks coming down to close to $60 a barrel, coming back up a little bit. So I think it's a fair assessment to say that oil prices right now are reflecting global macroeconomic conditions and the extent to which these are impacted by the recent trade tensions.
Another interesting point was that the report expects the Federal Reserve to continue with the easing policy for the remainder of this year. At the time where the report expects the downward growth or downgrades growth for the US by 0.9 percentage points for this year and increases inflation expectations by 1%. So given that inflation is going to increase, why do you still expect the Fed to decrease rates?
Well, so one thing is that even though inflation expectations have been revised upwards, 3% this year, inflation is still expected to decline between this year and next year. We're expecting 2.5% headline inflation in 2026. So there is still a path to disinflation. It's just delayed. We're expecting to be back at 2% this year in our January projections. Now it won't be until the end of next year. So that path of disinflation is being delayed, but it's not stopped. And so from that perspective, it's appropriate for the Federal Reserve, in our view, to see, of course, how things are going to be developing. The trade tensions and the tariffs should manifest themselves as a change in the level of prices, so they would have an impact on inflation that should be temporary. But there are lots of risks around that. One of the concerns we have, and I'm sure the Federal Reserve shares some of that concern, is what will happen to inflation expectations. Everyone in the US and many other parts of the world has lived through this inflation episode with a surge of inflation to double-digit levels not seen in 40 plus years. And therefore, everyone now remembers, everyone knows that if inflation starts again, they might be much quicker in adjusting their wage demands or businesses adjusting their prices. And therefore, we might see inflation expectations de-anchoring. And that's the worst scenario for the Federal Reserve. So it has to be very vigilant about that. So this is why, even though we still anticipate that along our reference forecast, some amount of easing of monetary policy will happen, it will maybe delayed until the Federal Reserve can assess things. During that time, let's remember also that monetary policy remains contractionary. The interest rates are still at a level, given inflation, even if inflation is revised up, where it's above its neutral rate, and therefore it's providing some amount of contraction to the US economy that will help bring inflation back to target.
But your base case scenario for now is that the Fed will ease for 2 cuts.
In our reference forecast scenario, we are still anticipating 2 cuts for 2025.
Let us talk about the dollar, because in previous times of trade uncertainty, the dollar had increased. This time it's different. The dollar has been on a downward path since February. My question is twofold. First of all, could you explain to us why do you think this is so, and do you expect that to continue? And second of all, do you think that this is intended by the administration, so a shift away from the strong dollar policy?
Well, I think that typically when you have tariffs that have been imposed in the past by, for instance, the US, the dollar has tended to appreciate. And I think that we can look back at what happened in 2018, and that's what we saw. So I think that was a very reasonable expectation. This is what economic theory would suggest, that the currency of the country that imposes the tariff would tend to appreciate. There is another side to this, and that other side was important in that particular case. The reduction in growth prospects for the US, a very significant reduction in our projections from 2.7% to 1.8%. That's almost a 1 percentage point reduction in growth. That's quite significant, quite persistent. That is leading international investors to also rethink about how they want their portfolios to be allocated. The uncertainty around trade policy also adding to the nervousness of the market and leading them to also want to adjust their portfolio mix. And then the final point is this is coming out of a period during which, if we think about the last 5-10 years, there's been tremendous appetite for dollar assets not just the bond markets, but equities, enormous inflows into US equity markets, the boom in the tech sector, in the AI sector, a lot of enthusiasm about the strength of the US economy over that period. So that has supported the dollar and supported risk markets and other markets in the US. What we're seeing is a rebalancing compared to those expectations and those set of projections, a little bit away from from US-based assets, and therefore leading to a decline in the dollar, leading to a reassessment of valuations in US equity markets and bond markets. All of this is happening in, I want to say, orderly fashion. I mean, of course, there's been volatility, there have been little pockets of stress, but nothing really too alarming. And so this rebalancing is, I would say, something that is very reasonable at this point.
Is it intended, do you think?
It's very hard to tell. I don't think that the policy at this point is to try to achieve a certain level of the dollar. It's more to sort of address the trading system itself.
Let us talk about China. What is happening in the tariff policy of the United States today is a result of the imbalances between the US and China when it comes to domestic demand. Do you think that as a result of these tariffs, we will see a change in China whereby there is increased domestic demand, which is basically what the Chinese government had been saying for a long time, but it hadn't materialized?
I mean, it is the case that the Chinese economy needs to rebalance its demand towards domestic demand as opposed to externally driven demand. That's something that we've long identified in our reports about the Chinese economy, in our policy advice to the Chinese authorities. We've advocated for this. And we think that's one of the key planks. I mean, in terms of our recommendations for the three large economies, the US, the Euro area, and China, each of these recommendations are aimed at trying to help solve what we call domestic imbalances. So in the case of China, it's very clearly try to move demand and support domestic demand by providing safety nets, by encouraging households to consume because they may be less uncertain about the future, therefore they can engage into more domestic consumption. That will reduce the trade imbalances from the perspective of China vis-à-vis the rest of the world. The Europeans' investment in public infrastructure, boosting productivity, boosting growth, that's something that will also help rebalance their economies in the context in which they, like China, also have aging populations. Aging populations are happening quite rapidly in some cases. In the case of the US, rather than focusing on trade, think about what's happening on the fiscal side. This is an economy that's been doing very well, but on the back end, there have been pretty elevated fiscal deficits, 7% or more. Clearly, that's something that at some point needs to be reined in. If you do that, there will be more savings in the US economy, and that saving will actually be useful in terms of covering some of the deficits. And so the global economy can rebalance if each of these three blocks starts doing the right thing at home. Dealing with the domestic imbalances helps with the global imbalances.
I know our time is up, but very quick question. Do you think as a result of increasing tariff rate in the US from 3 to 25% today, there will be a structural change in the US?
I mean, there will be, if those level of tariffs are maintained, there will be many structural changes in many parts of the world. We are a very integrated global economy at this point. Supply chains are very integrated. Parts of the supply chains are also happening in the US. The consumption, R&D, a lot of steps, often very skilled steps, are happening in the US. A lot of that would have to be changing in very profound ways if somehow we have levels of tariffs that are preventing an efficient level of trade and economic integration.